Hey everyone, this is Michael, and this is the Market Trend Advisory weekend video for April 9th, 2022. Before we start, this is our little disclaimer. If you want, you can pause the video and read it. Let's go ahead and just get started. So this week, the Nasdaq, we did switch from a market in uptrend back to uptrend uncertain, with the market uptrend under pressure. We didn't have the greatest action this week, so we're starting to get a little weakness coming in. So for the actual index action signals, we've changed it to lock in some partial profits for both the S&P and the Nasdaq. And then for individual stocks and non-index ETFs, we've moved our exposure down to 15 to 20% for both of the indexes. We're just not seeing stocks act very well at all. And that's been the case for really a long time, all throughout basically 2021 and the beginning of 2022. We did have a quick ramp up about, I think a week ago, 10 days ago or so, when we quickly ramped back down just because the stocks are really just not acting well. There's been a few sectors, of course, like energy and some of the cyclical areas, agriculture and chemicals. Those have acted pretty well, but overall, it's been a very difficult market, and people are finding it's not easy to make money in this environment. Excuse me. So we did have for the Nasdaq, we had another market count sell signal on Friday, and that was with a break below the 50-day moving average, and that brought the market count down to 3 out of 5, and now we have market exposure of 75%, coming down from 90%. The S&P didn't have any sell signals, and it's still at a maximum 5 out of 5 market count with 100% exposure. It's holding up better than the Nasdaq. Institutional selling days are still pretty low, though we're starting to get a few days in a row now. They're coming in, so we're going to watch that. Once we start getting to 4, we get 4 in a short amount of time. I think it's 8 days. Then we start getting some clusters, and that creates more sell signals. So we'll be watching that. And then finally, the power trend and the Nasdaq did go under pressure. What that means is under pressure just means you can't go back above 5 anymore. So the maximum will be 5 out of 5. And when the under pressure designation lifts, it means we go back to the normal thing. But there's a few things I won't go into here about what has to happen for that under pressure to come off. But so right now we're just basically maximum of 5, so we don't have that buffer anymore. And for the S&P, excuse me again, the power trend's still on just because it's acting a little stronger than the Nasdaq. So for our investing strategies, on Monday, we should be reducing exposure from 90% to 75% because we did have that market count of 3 now for the Nasdaq, and there's no action taken for the SPY. The results are just not very strong this year, just because we've started off on a negative for the whole year. The market count 2x is slightly worse than the QQQ buy and hold, but considering it's double leverage, that's actually really pretty exceptional. Now our 3x is performing worse just because it's got a lot more leverage too. And one of the things too is that in this kind of environment where the market's kind of either shot way up, when we had the follow-through day, and then we were really far away from any sell signals. For even to come back down to the 50-day or the 21-day, it was a pretty long distance. So we find that when the markets do this kind of thing and then they start grinding up and down, it really makes the strategy kind of go in and out. So it's not as I'd say profitable than when you have other types of markets. But again, these are all trending strategies. So when the trend is uncertain and stuff, you start getting a little bit worse performance. But overall, we're actually holding pretty well. And one thing I do want to say too, if any kind of a negative environment where the market overall is just down, I would only look at the market count 2x strategy, just because we're not really making any money at this point. And so the 3x, I would leave that for when we really have the signs of a really strong market, and it's heading basically up consistently. So we don't have that at all. So we would not be investing in this one, but for now we track them all just so we know what's happening. And then for the S&P, the SPY, we have a little bit better returns because it's been holding up stronger, but our market cap 2x has been forming a little worse, nothing too bad. And that's it. And then we did add a little optional stop loss just because some of those moves were really big, and to come down even to a market count sell signal, you might be quite far below. So this is something that investors can use. If you find yourself more than 5% below any of your purchases, you would exit that purchase. So, but we're not going to use that for tracking our numbers here. We just use the straight ahead system. So let's go ahead and just take a quick look at the Nasdaq. Here you can see we did break below the 50-day. That's this red line. Now also we just started to turn up on the 50-day moving average, but we're still between the 200-day and the 50-day, and even we're below the 21-day, which is the green, and the black one is the 200-day. So, and you can see the relative strength versus the S&P has just continued to decline. It's starting to look more and more like this may just have been a bear market rally, but we'll see. And that's this kind of action where you open low, close high, and just really powerful thrust off the bottom. It's really more typical bear market action than bull market. So we'll continue to watch that. The S&P is holding up better. You can see it's right at its 200-day, the black line that's giving it support. And we're still above the 50-day, which is now turned up also. Again, the S&P contains a lot more of the cyclical and industrials, and that have performed a lot better than any kind of growth stocks, which are mainly in the Nasdaq. So here's a chart I don't really show very often. This top line is the Amex. I'm not quite sure why. I can't get this off the chart, so just ignore that. The bottom line is this is the Nasdaq, the bottom chart, and this is the Nasdaq Advanced Decline line. And you can see that it's really for getting close to a year, 10 months now, it's basically just been trending lower. It did actually prove to be a little bit of an early warning sign here when we hit our peak, all-time high here, and the decline was coming down. But it doesn't have a great history of that kind of prognostication, so we don't really use that. But really, you can see it's not acting well. And so why has the Nasdaq been so weak? Well, part of it is because of interest rates. That's really, I think, the number one thing that the market is worrying about now. And for most growth stocks, or high valuation stocks, they're really being considered more risky now because higher interest rates are limiting their future profit growth. And that's something that is why you've seen so many of these high flyers just get chopped in half or more. I mean, some of them are down 80, even 90%. We've had a big rally off the bottom. That's been a lot of the rally of the last few weeks has just been these beaten down growth stocks where they're piling back in. But they're starting to get hit again as interest rates just really continue to go higher. So this is the 10-year note chart. And the 10-year note really is used for mortgages. And so this is starting to become a problem for anyone trying to get a loan, with interest rates. I read an article just today where people are finding that, they were getting qualified at one rate, but now, maybe they thought they were able to get a mortgage at 4, and now they're actually finding that it's really now 5. And that difference is, $300-400 in a month now in their payment, and they're not really able to afford the house that they thought they could buy. So it's all these interest rate hikes are starting to work their way through the system. Here's another one of the 5-year note. Now this is just an amazing chart. This is the bottom in 2020, and the note was at about 2, and we're at 27. That's a huge run in a short amount of time. It's actually taken back the whole move, almost going back to 2019. So this is a concern for the market. Doesn't like anything to move quickly, especially interest rates. And so let's take a look now at this chart of the 10-year note going back to 1965. So you can see this really had this final plunge, which is sometimes happens at the very end of markets. And we can argue too that, from 1980 all the way down to 2021, where we have a 40-year cycle of declining interest rates. You could probably argue that that cycle is over, and probably we're now starting because we're seeing inflation. The Fed no longer is going to be able to just keep cutting rates, kind of placating Wall Street every time there's a problem. That's been their modus operandi. Wall Street comes crying to the Fed, oh, we're losing money and all this, and the Fed cuts interest rates and everything's rosy. And it kicked off. If you look back in 1982, this was the start of the huge bull market that started in the stock market, and also corresponded with the decline in interest rates. So it could be likely that we are no longer in this environment, especially with this final blow-off where real rates went negative, where and it's actually pretty amazing, around the world, a lot of the huge funds are actually willing to take a negative return on their holdings. We're not talking about you and I, where we have a CD and we're not getting anything, but hundreds of billions and even trillions of dollars that these sovereign wealth funds are parking in things, and they're getting a guaranteed loss. It really makes no sense. A lot of things in the markets don't make any sense anymore, and I think that's because a lot of it has been absolutely dislocated with the trillions of dollars that got pumped into the system, and now they need to be pulled out, which I think the Fed is starting to have no choice but to start taking that out by reducing their bond buys, not putting the money back into more bond purchases. And that is what we're seeing here. Now that that's starting to happen, or at least the fear of what's going to happen, markets always anticipate, and they're already really making a huge run. So this is a big headway for stocks. And if interest rates continue really up, if you kind of averages out, you're going to be around 4%. Well, that's almost double where we are right now. Actually, no, the 10-year note is at 2.72. But another percent interest rate run higher really would put a damper on stocks and would probably portend a long period of down to flat performance. But we'll see. I mean, anything can happen. It doesn't mean that this is going to shoot up anywhere high. It could just kind of stop around here. Nobody knows. But the whole key is to get a hold of inflation. So this is something to watch for. But you can, again, argue that probably that long-term interest rate fall for the last 40 years is probably over, which has helped the stock market immensely since its bottom in 1982. So the final thing I want to talk about today is just we have earnings season coming up, which seems like we just had earnings season. So anyways, it's coming up in the next 3 weeks. And I think investors now are really going to be tuned into what companies are going to be saying about these 5 issues. And to give them more color about what really is going on under the surface. So, of course, the first one is inflation. Companies are now having to raise their prices on things. So far, it hasn't seemed to have affected any of the demand because people seem to be buying anything at any price. Could be just kind of reaction to the COVID years where nobody could buy anything, and we're also seeing difficult to get stuff. So this is one thing they're going to be looking for: how companies are dealing with inflation. And one of the interesting things too is that we're finding that bond buyers would rather actually lose money, because if you're anybody who's bought a bond in the last 4 months or so really now has a loss on their principal because of the interest rates going higher, and bond prices work inversely. So you've actually overpaid because interest rates now have gone higher. But what's happening is that bond buyers would rather take that loss than actually risk and move the money into the stock market. So they're not seeing a lot of upside in the market, and that is because of inflation. And that's sort of a different scenario than we've seen in a long time. The second part of that is, the Fed's no longer being supportive, and that they're actually, of course, everyone knows this, they're become more hawkish, and they're signal their intent to combat inflation by continuing to raise rates as much as they have to slow down the economy. So that's the big risk here with inflation, is that are we going into any kind of recession? And that's what people are going to be investors really looking forward to hearing what companies have to say about that. We do have an inverted yield curve that's happened. That's another precursor to inflation. So this is going to be real important if companies are overall starting to see real problems with that, or they're going to be raising rates and they're not really hitting the demand on that. That's going to be a problem. The second part is supply chain. Everyone knows it's been difficult to get stuff, and companies are really dealing with that. I saw a headline that Chinese electric car maker NIO actually had to stop production altogether because they can't get parts from their suppliers because of the continued COVID cases over there in China. So that's a big issue. We have the ongoing Russia-Ukraine conflict, which doesn't show any sign of ending. That's can be affecting global growth, especially with all the sanctions going on and not having Russia as any kind of trading partner. We're also seeing as COVID is really increasing in Asia, is how's that going to be affecting things? Just like in NIO, if they're shutting down because they can't get parts, that's going to affect other companies all around the world. I know there's been an ongoing chip shortage. That's been a problem for car makers and other equipment makers because they just can't get the parts. And then finally, what's the impact from rising interest rates on companies with their financing costs? I did see something, I think Home Depot was borrowing money, I think at under 2% just a few months ago. I think they borrowed $1 billion and they went back to the market, and it was substantially higher, I think a full percentage point higher. Of course, a company like Home Depot, that's may not made much of a difference. They're also probably refinancing higher interest rate loans down to lower. But again, it's starting to show up that their companies are having to borrow money at substantially higher costs than they were just a few months ago. So again, that's all going to be stuff that investors are going to be looking at when earnings season starts. And in aggregate, what they find is going to be kind of being priced into the market. So that's about it for this week. We'll be back next week for another video, and just continue to follow the system. I think this is, no matter what happens, we'll see those actions show up in our system and what the market's actually doing, not what we think it's going to do or hope it's going to do. Okay, thanks a lot. All right, bye.